If you don't know how to play around with different time frames, then you're never going to be able to utilize the FVG properly. You've probably spent more hours than you can even count studying ICT, but all that is meaningless if you don't understand this one thing about fair value gaps. And that one thing is being able to align the different time frames. It doesn't matter what kind of trader you are. If you're a day trader, swing trader, or a scalper, it does not matter. Time frame alignment is the most important thing to become a profitable day trader. If you want to catch sniper entries and actually be able to execute off the proper fair value gaps, you're going to have to learn how to use different time frames with fair value gaps. In this video, I'm going to give you a piece of advice that's going to change the game for you forever, because I came so close to quitting trading after spending hours on end studying ICT's content. I learned every concept. I learned everything that he had to say and teach, and it wasn't enough because I didn't understand this one simple thing, and that was time frame alignment. So without further ado, let me show you what time frame alignment is and how you can pick and choose the right fair value gap inside of a move. Before we get into this video, there's one more concept that I have to cover, and that's premium and discount. If you don't understand premium and discount, you're not going to understand which fair value gaps are going to be valid in a move. This also goes hand in hand with time frame alignment. So without further ado, let's hop straight into the charts. So before we get into the main video, I wanted to break down premium and discount, because without premium and discount, you're not going to be taking the right fair value gaps in the first place. And that's because you have to understand that if there's something below a fair value gap, or if it's not in the discount and you're looking for buys, then it's likely going to trade lower before running up. So inside of a premium and discount, you're looking for fair value gaps for buys inside of the discount. The discount is under the 0.5, essentially the midpoint of a move. Underneath the 0.5, wherever there rests a fair value gap, that's going to be a high probability area for you to get into a buy for a continuation move if you're looking for buys. If you're looking for sells, it's going to look the same but in the opposite direction. So for sells, you're going to be looking for a bearish move first. And then once that bearish move is created, you want to find a fair value gap that's somewhere above the midpoint of this move, above the mean threshold, which is the 0.5. When you get a fair value gap that forms there and it runs back into it, that's a high probability area for you to sell your positions or to get into sell positions. The reason this is because when market is trending bearish, then all the buyers inside of a bearish market are going to sell their orders in the premium at the most expensive price that they could sell it for. That way they can make a profit on the price that they bought it for. If you're selling and you're looking for a continuation lower, then you're obviously going to also want to get into the move where it will continue from the premium. So you're going to get in at the highest possible area that is going to want to run from. Premium and discount is very simple. It's just the midpoint. Above the midpoint is the premium and below the midpoint is the discount. If you're looking for buys, you're going to want to find buys inside of the discount of a bullish move. And if you're looking for sells, you're going to want to sell from the premium of a bearish move. Now I just want to make sure that I convey to you guys that this is a puzzle. Without one piece, the puzzle is incomplete. So just because you know about premium and discount in fair value gaps, you're not going to succeed using them. You're going to have to align all the pieces of the puzzle and learn to adapt them depending on the scenario in the market. This means you're not just going to stick to the 15-minute time frame. You're also going to have to use the 4-hour and the 1-hour and the daily and the weekly. That's because you have to understand the narrative on each time frame in order to scale down and actually take a trade in a specific direction. So let's hop in the charts and let me show you how to use fair value gaps to read the most high probability fair value gaps. So the second piece of the puzzle is going to be time frame alignment. If you're a complete beginner to trading and you don't even know where to find your time frames, it's going to be on the top left of your screen. So on TradingView, you have the time frames right over here. And in order to favorite them, you just drop it down right here. You even have the second chart if you're trading futures and you want to be really precise with your trading. But typically 1 minute should be enough to become a profitable trader or even just taking scalper entries. You're not going to have 12 different monitors looking at all these time frames at the same time. Essentially, just when you're starting your trading day, you scale down from the highest time frame down to the lowest time frame to make sure that it all makes sense and the time frames align. The same narrative that's showing on the daily is also showing on the 4-hour and the 30-minute and the 1 minute. And that's when you are confident to actually place an entry. So let me show you why it's important. So the reason why time frame alignment is actually super important for fair value gaps is because on each time frame, the length of the candles is going to be different. And as you guys know, fair value gaps are the gap between 3 candles. So if each of the candles are a different length on the different time frames, Obviously on different time frames there's going to be a different fair value gap. It's either going to be located a little lower, a little bit higher, or if say there's two 30-minute fair value gaps on the 30-minute time frame, on the 1 hour time frame it's just going to be one fair value gap. So what's the importance of all this, and how can we actually use time frames to our advantage? So the biggest mistake that ICT traders that trade fair value gaps make is that they don't use the different time frames to actually determine a valid setup. So I'm going to show you right now with this specific example what I mean. So you can see right here on the 30-minute time frame we have a fair value gap, and as you guys may know, if the candles close above a fair value gap, it's no longer valid for a bearish move. That was a bearish fair value gap, and so price should have respected it to actually go down from it. If it closes above the fair value gap, then instead market is likely to move higher. Here's why you as a ICT trader would fail from this setup. That's because this is the 30-minute time frame. However, on the 1 hour time frame, if I go to the 1 hour time frame, you can see that the 1 hour time frame fair value gap was slightly lower right here. So there's the 1 hour fair value gap. And if you stretch that out, you can see that this candle didn't actually close above the fair value gap on the 1 hour. The 1 hour time frame is more significant than the 30-minute. So instead of getting a long position from that 30-minute fair value gap that got disrespected, you should have instead been able to determine that this setup was still valid for sells, because all you had to do was wait for the 1 hour candle to close, which is more significant. So if there exists a higher time frame fair value gap and you're trying to use the lower time frame, you're making a crucial mistake. You can see here that even though it closed above on the 30-minute time frame, the market ended up running on sell side from this fair value gap. So this wasn't a bullish move, and you would have gotten faked out if you were looking for a bullish move just because the lower time frame disrespected a fair value gap. So now that you understand why time frame alignment is super important for determining a valid fair value gap, I wrote down some notes for you guys. So the higher time frames are obviously going to be more significant than the lower time frames. The second thing is that lower time frame disrespecting a fair value gap does not validate a move unless the higher time frame also disrespects that fair value gap, especially if there exists a 30-minute and a 1 hour. It's the same with a 1 hour and a 4 hour. And lastly, a 4 hour is more significant than a 1 hour. So obviously you may think that you found the narrative from the 4 hour time frame, which did a specific thing that aligned with the 1 hour, but that doesn't matter if the daily narrative is different from whatever's showing on the 4 hour time frame. That's because the daily narrative is more significant than those. So make sure that all of the time frames align for you to actually take a setup. So those are the two most important pieces of the puzzle, but those two in themselves are not going to make you a profitable day trader. There's other key factors that you have to know, like timing of your trades, and other little factors like news events or anything else that might be driving price in a specific direction. But I did want to end this video off by showing you an A+ setup and how I would personally dive into the market with a top-down analysis to take a trade. So without further ado, let's hop into the final part of this video. So I know a lot of you guys are going to say that I'm cheating because I'm in replay mode, but the point of this video isn't to flex that I got a profitable trade. It's to show you guys what goes into a profitable trade so that you can replicate it yourself. So before we hop into the actual charts, let's break down what makes an A+ setup, because I definitely left out a lot of features in this video. So the first one's obviously going to be session. You have to trade at the right timing. The second factor is going to be some sort of a liquidity sweep. In order to take a valid fair value gap trade, you typically want to have that fair value gap form after a liquidity sweep. The third factor is going to be premium/discount, depending on whether we're selling or buying inside of a range. The fourth factor is going to be price respecting the fair value gap that it is inside of. And the fifth factor is going to be the time frames aligning, making sure that your narrative before you actually hop into this trade is pointing to the same direction on each of the time frames. So make sure that you know each one of these things before you go into a trade for an A+ setup. So now let's actually hop into the charts. I would love to start from a higher time frame than the daily, but I don't want to overcomplicate it for you guys. So my narrative is coming from this daily IFVG right here, and price just came up and swept a previous high on the daily time frame and tapped into this daily bearish IFVG again. This daily candle closed. So what we're gonna do is we're gonna try to catch a trade in the next daily candle that opens. So we start scaling down and we wait for the open of the next daily candle. So I want to ask you guys something. Do you think that this fair value gap right here is going to be enough to take a sell trade down towards our bearish narrative? And the answer to that question is going to be no. And the reason why that is because the new daily candle has yet to open and it's not a valid session yet. So it wouldn't So while it might be a fair value gap that's in the premium of this bearish leg right here, it's still not a valid entry because some of the other factors of an A+ setup are missing from this puzzle. Just for your information, I'm on the 30-minute time frame, so now let's see for the next daily candle to open. So there you go, you can see that we disrespected it here, probably because the next daily candle also wanted to dig into the daily bearish IFVG. So now that we actually dug into it, now we can start looking for a setup. And this is where we would actually be looking for a new fair value gap to form that we can take a setup from. So like I mentioned, if we're looking for a fair value gap that's actually valid, we want to have it in the premium of a bearish move. So if we're running down, we want to see it actually run down and create a fair value gap. So let's wait for price to run down. Now that we've actually created a fair value gap, if we begin to start moving back up inside of this leg, we have a valid fair value gap that we would want to be taking a trade from. So let's see if we actually pull back up into this fair value gap once we create a low. And there you go, we pulled up into this one right here. Maybe we'll dig a little bit higher because we barely missed it. So you can see that we dug into it but ran straight through it and actually used it to go higher. This is not yet when we would look for a setup. We want to see price actually close in the middle or just inside of a fair value gap. So we wait for another bearish leg. This one also got disrespected, so we wouldn't be looking for a sell setup just yet. Let's look for another bearish move that actually gives us a fair value gap that we can trade from. So here you can see we finally began to expand again and we created a new leg. So now inside of this bearish leg, we want to find a trade from the premium so that we can actually take sells towards our bearish narrative. So let me wait for it to pull up just above the midpoint of this range. There you go, we finally pulled up and we can begin to layer in our positions. So I'm gonna go in here with 7,000 contracts. I don't know how much that is in a real account, but we're risking $100,000 on this trade and we're just securing our stop loss above. This right here is a valid fair value gap because not only is it in the premium, but it also aligns with our bearish narrative on the daily time frame. So now that we can actually take a trade, we can see that the market's actually respecting this fair value gap as well. We're likely going to expand towards sell side and secure a lot of profit. So here we walk away with $200,000. I hope you guys learned how you actually use the different time frames to find a fair value gap. I hope you can also see how I use some of the tools that I taught in this video, like the premium and discount and the time frame alignment. So I'd consider my job here done because we walked away with $240,000 profit. So you guys really need to lock in on this fair value gap stuff. Without further ado, if you enjoyed this video and comment something new that you learned that you're going to adapt in your trading system. Thank you all for listening and subscribe to my channel if you want to see more videos just like this one. Catch you guys in the next one.